Hey, good morning, all. Happy Thanksgiving to everyone. Veteran here with ITG, Independent Traders Guild, and going to run through year to date, but we're going to look at the ES at a tighter time frame and kind of go through a process that I go through weekly, and when I do my weekly preview. Uh, so in front of you, you've got a 4-hour ES chart that just allows us to go back to the start of the year, and we have the high. And again, I've already expressed it in multiple videos, but again, a Fibonacci retracement, a simple Fibonacci tool that's right here on TradingView, a fib retracement tool from the high of the year down to the October lows. Let's get that in there. And it's just standard default. I haven't changed anything. I have the numbers on the right, and it's colored in because we're going to draw more fibs as we go. And then we've got the trend line, which was from the January high to the March highs around the 29th. And again, if you extend that trend line, and I did a video with it earlier, the red line is the 200-day moving average on a daily chart, and the white line here is a 50-day moving average. On the previous video, it was a 200-day moving average. So just wanted to, and maybe I'll change the color. I typically use red, white, and blue, where shorter time frame to longer time frame, vice versa. Something I just have done for decades. So again, I just want to show you where the market crossed, and Wall Street, CNBC, Bloomberg, Fox Business. When the market crossed, that's when everybody got negative. But you'll see that when the market actually crossed on the 14th of March, that was damn near the low. You got to be careful. Again, the talking heads are going to tell you what they've always heard and not necessarily know the how and the why behind it. You don't sell at that spot when they cross. And you can see that if you obviously took profits, or if you sold out around 41.40, and then we bounced all the way up to 4,600, 46.32, almost a 500-point move after the quote-unquote death cross. So be careful there. So again, we have a trend line, we have 50-day moving average, we have 200-day moving average, and we've drawn a Fibonacci retracement. That's all we have. Now, if you draw your extensions on your trend line and you let it extend down to the right, crazy, but look how close we came to that trend line in August. And so this is when my wife and I were in Hawaii. Not only we get up, we pushed the trend line, got close to the trend line, but we got rejected by the 200-day moving average. So you have two things that were involved here. You didn't have this line, and you didn't have this line because we didn't have this low. So let me do this real quick. Up until that point, this was the low of the year. So when you get up to this point, if you look left, we didn't have any Fibonacci to tell us this is where we were going to stop. We just had the 200-day moving average. Sometimes it's enough. Sometimes the trend line. When you have two simultaneous, there's a lot of confluence there for it to reject and keep moving lower, or an area that if it does get above it, you're going to get a pullback back to it to get long. So you had two plays there, but the clear play was to liquidate because of the June lows. So now let's get back to the regular video. I'm sorry, I'm so ADD. I get off track big time. Now, with it, this is the importance of the trend line, is because now we've got another level here. So what I do is we made a swing low or a swing high, and it was lower, but I want to go back to that high point. Because to me, that high point, why are you, there we go. That high point here is more important than that high point there. So I want that line to be as accurate as possible down here, and that's this anchor, not this anchor. They're close enough, guys. I mean, don't split hairs on it. but it's there. Now what do we got? Okay, so we got the October highs or August highs to October lows. So here's the next fib. So I put them in purple just so that I can dictate my yearly. I typically from the high of the year to the low of the year, I typically let it default and I color it in and I leave those levels. Then when I get to a major high and a major low, i.e. August high, August low, that's our bookends. That's our major range that we're in right now. I colored them all purple so I can quickly look left and you'll see here, you'll see in here the confluence in the 4155, which is the midpoint, the 50% high year to low year, and the 786 is at 4150. You can bet your last dollar. There's two lines right there and levels right there. They're going to be important. Okay. And so now we've got multiple. Look left. So you got the 618 at 4072, and you got the 382 from the high of the year at 4,000, or no, I'm sorry, 4012. And so with it, that becomes important. So now we have trend lines and we have Fibonacci levels from two pretty big points in here. Then I get into, and again, I apologize, the volume profiles are there. They actually shouldn't be on there yet. So that's my process. Then my next process is to go find out where is supply and demand. Because this Fibonacci stuff is all pattern recognition, repeatable math. It happens in nature. The markets typically, they don't follow it, but they respond to it. They respond to the confluence at these levels. They certainly respond to the confluence at 4150, 55. They're going to respond to the confluence right here. They're going to respond to the confluence right here, and you can see that we climbed up to it, and we had two levels, and then we rejected back down. So those are important. Then I go and I look at supply demand. I have a video on supply demand. Supply is an excess, an imbalance of sellers, where people are waiting to take profits, and there's an excess supply in the system, i.e. the equities, the instrument, the stocks, the commodity, the futures, they're more valuable than the perceived market. And so you're going to have more sellers than buyers. So you have quote unquote supply. To the downside, you have demand, an area at which an equity and asset is of such discounted value. There's more people willing to buy it at that price than there are people willing to sell it at that price. You don't want to sell at the bottom and you don't want to buy at the top. You want to sell at the top, and you want to buy at the bottom. You want to buy into a demand zone where the price is just too demanding. It's too good. So there's a great amount of demand for the product at that price. Okay. So simple enough. So I've already drawn a few, and I'm just going to click them on the higher time frames that we're dealing with. We're really only going to deal with now. We're going to erase everything to August, except for the fact that we're going to keep all these Fibonacci levels because they become important. So with August, what do we have here? We had the price move up off the June lows, back down, and so we're making a swing low, a higher low, and a higher high, and a higher low, and a higher high, and a higher low, one of these two, and a higher high, and then we make a higher high, and now we get back and we make a even low. Alert, alert, alert. Well, we got up in this zone and we hit the Fibonacci level, or not the Fibonacci level. We did cross over a Fibonacci level here at 4309. We hit the 200-day moving average at 4324, and we missed the trend line, but the trend line was there. So there were three levels right here capping this move, and I'm gonna expand it just a little bit. It's harder to see on a 4-hour, but it is important. As you get up into there and you start understanding candlesticks and wicks, exhaustion, and you get into that zone. We had three areas in that vicinity. Realistically, we had three areas right there that told us we're in trouble. Guys, we need to figure that puppy out. This is again, we were in Hawaii. This is when you start to take money out of your 401k and reallocate it back towards money market accounts if you have them. Um, this is when this is when you peel off your positions. This is when you look at short-term trading and go, okay, um, the most recent swing low was here. Are we going to retest it? This is when you buy short-term puts for the next month or the next 3 weeks to see if they profit. And if you're not sure what put strikes to play, well, you got a fib level here at 42.28, which was 100 points down. And then you got 2 fib levels down here at 41.55. And so again, this is how you can make short-term just immense amount of profits. I mean, and in ITG, I say it all the time, just stupid money. Just stupid money. And the only reason why this became in play is you start looking at the candles and every candle's red. That's how you know this was a supply area where there's going to be an excess of supplies up here because nobody wants it at this price. And this is where algorithms will take it lower and lower and lower. And you can see we were straight red from the 18th of August down to the 22nd of August. And it's not until you start getting some green in these Fibonacci confluence that the market actually starts to become more two-sided, both directions. So a lot of bulls get trapped up here. And again, our job is to try to educate and warn people so they don't get stuck in a supply zone, buying in a supply zone. You want to sell into this upward momentum and play the opposite side. So that's what we got. And then down bottom, obviously, we've got a larger time frame demand zone. How you draw them, it becomes really important. This is the demand where it was created. But if you go back, we had a short-term demand that was created here. Why? Price action's coming back down. We put in, a lot of times you'll get a long, like right here, a long down wick. That's called a pin candle, referred to as a pin candle. And then a violent strike move back up. And again, the speed at which the market moves back up is important. And so knowing these are our two higher time frame, our two or higher time frame levels, and again, we don't need to get too far forward, but knowing these are the levels, do you see any others that are the market's moved up and then spike back down? As you go back in history, you can start to see where the market moves up. And again, I'm on a 4-hour chart, so you need to do this on a daily, a 4-hour, a 1-hour to see your higher time frames, and then a little bit shorter duration. So the next two come into play. The next two come into play at these zones where we moved higher. And the way I draw supply, everybody is going to do it a little bit different. But the way I draw it is I want to see the violent move down. And then I want to go and I want to get the base. I want to get the previous candle, the last exhaustive candle. And you'll usually see it's a smaller green body. I hate that the cursor does that. But you'll see that it's a smaller green body, smaller green candle, right? Big candle, big green candle, balance, impulse move, gap open above the 50-day moving average. And again, even though it's a 4-hour chart, this is anchored to the daily. Green candles, big bodies, small red, big body green. This is continuation of a trend. And then you get a green doji with all wick, and then a green hammer, but a small body, and a small red body, and a small green body. Guys, what do we got right above us? We got 2 fib levels right above us. I mean, this is like alert. Get ready to close out your longs. Take profit. Start legging into some puts. Exhaustive. Do not chase the market up here. And again, I can't tell you how many times we get this body, and then this next candle, the next morning, we move higher above those fib levels, and everybody buys. The noobs buy, the rookies buy, and they chase because they know we're going up to this level. No, they've already told us through this exhaustive move that we're there. And so I don't draw the supply off this big red candle. The big red candle to the downside, the flush, just told me that we had a violent move to the downside, and it just ate up, a whole bunch of time and days. You go and draw it from the top wick to the bottom wick of the previous green candle. So we have this supply zone, and guys, we're getting ready. This is going to come into play in the next week or 2 weeks. And then to the downside, you've got the same. And so I'm going to zoom out to where we currently are. And again, it's Thanksgiving, so futures are now closed. But then we got a demand zone where we climb up to a fib level, the half back from August highs to October low. And then we breach the 50-day moving average. And you see when we breach the 50-day, when we climb above it, sometimes it's a violent climb, and that's going to continue. But you don't chase it when we climb above it. The reason you don't chase it here is the 50-day, the white line is in a negative slope. So yeah, we violently climbed above it, hit a level, and then we came back to it. Now you want to see if buyers defend here. And they didn't defend here. We sold off right through it. And then we go down to the next fib level, down this purple line, and then all of a sudden, violently, we started moving back higher. Now, this wasn't a violent move higher, but it was a move higher. So somewhere in there, for some reason, on the 3rd of November, the market said, you're going to stop right here. You're not going any lower. We have no idea why it did that, especially when we had a purple line right underneath it, or we had this swing low right down here. But we have no idea. But for some reason, the market said you will not go any lower than right here. So someone said there's value there. There's demand there. Short term, not long term. Higher time frame, HTF demand. And then we have short term demand. And then we got back up to the 50. Again, just because you cross the 50 doesn't mean you have to chase. Why? Because we had that fib level right above us. Proceed with caution. We get up above it. Everybody's feeling froggy, waiting for the next purple line or the next level above us, and then flush. And we get back below it. If you just sit there and try and go long short over the 50-day moving average, you'll go crazy. You'll spend a lot of money in commissions. But then we had the huge wick up. And why did we have the huge wick up in November? That was CPI. So we got two more levels of supply demand. Another demand, another drop, and a violent move, a fast move to the upside. And that was pre-market. And then we got to a spot where we hit some exhaustion here. Big green candle. The next day was a big flush, and it didn't engulf it because it didn't get as high. But we took out the previous swing lows here. So the market came down. Where did it come down to? Fibonacci level. That's why we have them on our charts. They're important. And now look at where we are. Market moved back up, and we're now retesting. This demand zone or supply zone up here. And what do we got right here? The 200-day moving average. What do we got right here? The downtrend line from the high of year. So we've got three levels above us. If we do clear this, tomorrow being Friday or Monday, Tuesday, if we do clear it, we've got the 200-day at 40.62. We've got a downtrend line. It's going to be somewhere in this vicinity at 4,100. If we get above 4,100, are you going to rush into buying? I wouldn't recommend it. Why? Because at that point, we're going to now enter into a higher time frame supply zone than it is right here. Can it keep going higher? Yeah. But in here, I'm going to make the market prove me that it can get above 40.50. And you remember right here, we have 41.55. So what do we have in this supply zone? In this supply zone, we're going to have a break of the trend line. We're going to have a supply zone. We're going to have the 41.50 from August high. We're going to have the half back at 41.55 from the high of the year to the low of the year. I need to see the market get through this and hold and defend some levels before the market's going to go back higher. Now, that is high year, low year, swing high, swing low, Fibonacci levels. That is 200-day moving average, 50-day moving average. No big deal, but it does give us some guidance. 50-day is flat, 50-day is negative, 50-day is flat, but we're well underneath it. So then I go to the market profile, and I'm going to put the profiles in. I don't have them in the right order, but I'm just going to put them on, and we're going to talk about them real quick. Okay, so let's go back to because I do this is my third step. Okay, the first is I draw either the supply demand or the fib levels. I try to do supply demand first so that I don't draw and I don't force a demand in a vicinity where, like right here, if you know there's a fib level there and you're like, yep, we sold off, we hit a bottom, and we violently moved up, and I'm going to put a demand zone there because there's a Fibonacci level. Nah, I'm not going to do. I try to do the demand first because it is more subjective. The Fibonacci's, you kind of know where they are, but you got to get them on your charts because they become critical levels. It's support and resistance. Then you go back and you pull up a market profile. Now this market profile goes back to September. What you're looking for is peaks, and you're looking for low volume nodes. Okay, and the way I have always presented the market profile over the years is, to me, the mountains in the market profile are like cyclists, or they're like towns. It's really, really, really hard to go uphill if you're in Colorado, as we are, and you're mountain biking. But you go downhill really, really fast. Okay? Or towns. This is a city. Okay? This is a major city, metropolitan city. This is a city, and this is a town, and this is in between the cities. This is West Texas, where speed limits are 80 miles an hour, 75 miles an hour. There's no stoplights. There's no traffic signals. There's no traffic. You're on an interstate, and there ain't nobody else around you, and you're going as fast as your freaking car will let you go, or you're confident enough to push on the accelerator. And then you come into a town, and the speed limit slows down, and there's traffic. So we slow down here. This is where price gets auctioned. You have equal number of buyers and sellers. And then we get down in here, and this is what we call a low volume node. You don't have as many buyers and sellers here. This is a ghost town. This is out in the middle of nowhere. This is in the backwoods. And it goes really fast from here to here. And the reason why is because there's no one there. There's no stoplights. There's no traffic. There's no pedestrians crossing. It's a 4-lane interstate, and you're the only one on it. You're hauling booty. Okay? And so you see that because these levels slow way down. These levels speed up. And so when you look at a volume profile over a period of time, you're looking for where the low volume nodes are, because we haven't had a lot of price auction at the low volume node right in this vicinity, and we've got a fib level here. We've got a fib level, a POC here, and a fib level here. We don't have a lot of volume profile in this vicinity. So the market typically will get to it really, really fast. And this becomes areas of influence into the market. Think of it as a ball rolling downhill. It's going to roll down to the lowest point. If you're coasting downhill on a mountain, you're in Mauna Kea and you go to see the sunrise, you go downhill. You don't want to climb that hill. And it's going to run right in here, and you got a fib level in here. And so what is this fib level? 39.14. So when you draw this zone, if you look at from September to October, and you draw this, and you see this vicinity, because we haven't had a lot of price discovery in this zone at 39.50 all the way down to 3900. And it's not just current, again, CPI number, and then we had last week. And so we're at the downhill. If we get into last week's profile, we're in the downhill from where CPI was. We're still don't have a full auction through in October, and that was the October lows, the lows of the year, and not a great deal of auction back all the way back in September. Nothing compared to here, nothing compared to here, nothing compared to here, and certainly nothing compared down here. So with it, you're like, well, if I look at the market profile going back, I mean, I sit there and I go, wait a minute, this 39.14, 39.15 zone, if we reject up here, we're going to rush down here pretty fast, guys. And so this is how we trade. This is how you set up a plan. And you set up that plan that we're going to work towards a low volume node over time that has not been auctioned through, where we got people that got trapped down here. We got bears that got trapped down here, and they got trapped in a low volume node. And so that's dangerous. Well, then above where we are right here, you see the peak here from Tuesday. In terms of volume, we didn't have a lot of volume. That's a holiday week. We don't have a lot of volume. You see, you got a peak here for November. You got a peak here in October. You got a bigger peak here in September. And so when you draw that line from peak to peak to peak, that puts us around 39.75 in that vicinity. So that's going to be the first place that we got to see if bulls will defend this zone. And as long as they do, which way does a ball roll? Downwards, downwards, downwards. But look from the downwards. There's not much volume here in September. There's no volume above this zone in October. And that's just carrying forward. There's no volume here. So there's super low volume here over the last quarter. You can see these are real small levels because we came through them really fast in August. We came down really fast in August. So we didn't auction those off either. So if we do get above here, we could get up to the spot. Everybody says Santa Claus rally. Don't start smoking the hopium because we're just moving higher so the market can go and auction, these small, low volume nodes because there is one above us. And so there's always an opportunity for us to go higher. Always. Market likes to go higher, and there's low volume nodes above us. What we got to consider, if we reject here, where are we going to get to? We're probably going to get down to 39.75. Well, that's not too far. If we get below 39.75, then you got to get into this box. And this isn't a demand box. This is a box of low volume nodes going back for the last quarter, September, October, and now November. And there's a fib level here that's a 50% retracement from August highs to October lows. And so this becomes our first target. Well, if we fail this, where are we going to go to? Well, look at the profile. High, low, low, high. There's a plateau here and then a big low. There's a peak here and then a big low. There's a small peak here and then a plateau, but a little valley here. But then you got that 38.10 Fibonacci level. And it's a 382, so it's not the biggie, but you've got a Fibonacci level. You don't have a lot of support here. This was the demand, the CPI push up, and you can see we didn't auction hardly anything through this zone. And so with it, if we do fail the 39.15, 39.05 zone, then we're more than likely going to get back here and test the 38.17, 38.15, and the 50-day moving average is down here at 3,800. So you look at it like that and you're like, okay, well, so this is what we got going. So the last thing I'll do is I'll say, okay, I'm not sure which demand in this vicinity becomes the most important. There is volume here, but I'll just put it here because this is the most recent swing low up to, let's go with Friday. Let's go with the swing high. I'm going to go to default. I apply the defaults and then I go back and I just kill. I just kill the numbers I'm not interested in. Only thing I'm interested in is the halfback. And I will use yellow. And I will put the price levels on the right. Not letting me. Don't do that. Okay, so we got them on the right here. So if you look at this, and now, you start talking about the 0.5 fib from August. If we do fail this zone, and this is just nothing more than uh, pulling low volume nodes forward from a market profile. If we fail that node, if we fail, we might not go all the way down there, but we definitely are going to get into the golden area between the 0.5, the halfback from low down to the 618. And if we fail the 618, then you bet we're going to this fib level and we're going to the 50-day moving average. And if we fail the 50-day moving average, you start looking to take a long position in this demand, knowing that this demand might not hold up. We might go down to this one. But you do start to build long positions for a move back up into wherever the volume nodes are. And you start to go through a process then when we get there. So hope that helps. It's going out to YouTube and Twitter. So ITG folks, thanks for bearing with me. You hear me do this every day, all day, every day. But guys, this is how you make money. And 7 figures a year does not. It's not automatic. Doesn't come easy. Making your first million is the hardest. But building consistency needs to be your objective right now. So you guys have a great Thanksgiving, and we'll see you. Feel free to ask questions. Peace out.